Quick check of the morning's business news now. Peter Switzer, the founder of the Switzer Report, is here. The stock market taken off lately, Pete. I mean, this, at least for a few days last week anyway, it was quite pleasant to see for investors.
Yeah, it was, Pete. And as you know, I've been keeping my fingers crossed that the December quarter would bring a rebound like this. I think we're a bit surprised that the Federal Reserve boss, Jerome Powell, was so happy to entertain the idea that maybe interest rates could come down anytime soon, which surprised the market because the Yanks have been getting very good inflation numbers, which made us think that interest rate rises are over. But I think a lot of people were surprised when Jerome Powell, entertained the idea that rate cuts, may well come sooner rather than later. I think that really excited not only Wall Street but global stock markets, and we also picked up a bit of that positivity, and it's looking like the Santa Claus rally is starting early.
Okay, but why then is the market expected to fall 1% at the open, Pete?
Yeah, well, a couple of reasons. One, there's always the profit takers out there. Also, Pete, there's a lot of buying and selling of the stock market, AI and computer related. And I know there's been it's like the fluctuations of the stock market are being picked up by all these program trading software programs, but also John Williams, who's one of the voting members on the Federal Reserve, he's come out and said, oh, hang on, you're getting ahead of yourself here. We're not talking about rate cuts yet. And so what we call this in the business is jawboning. And by them actually, jawboning, saying, oh no, rate cuts, you're getting ahead of yourself, the market will sell off today. So they'll try and temper this recovery. But I think the stock market's rebound is here to stay, and it will roll into 2024.
Okay, well, that is something. So what are the big data drops for the week for stocks over the festive season?
Yeah, we're not watching the week. We're watching a few weeks now, Pete. And I think the key ones for us is going to be January 10. That's when we get the November monthly CPI. And the real biggie is that right at the end of the month, January 31, we'll get the December quarter and the December monthly CPI. If those three numbers I've talked about come out, looking better than expected, then the Reserve Bank may well be done and dusted with this interest rate rise.
Okay.
February 6th is the next time they meet. So those three numbers are going to be critically important.
Just to wrap up here, Pete, I had Ross Greenwood on the program. He drops in on Fridays and he talked about gold stocks, right? So some of them have gone up about 160% over the past 12 months or so. Now, I know you've got to be careful with advice here, but isn't it always just a good idea to have gold stocks? Because it always seems to be a rush on that during troubled times.
Yeah, I wrote a story about this recently, and if you look at the chart of gold prices going back 25, 30 years, it's great if you buy it when the price is low. When it's high, you can easily be locking in at the wrong time. It's like buying property at the peak of the market. But certainly, the argument from a lot of financial planners like myself is holding, say, 2% of gold is not a bad idea, but I still make the argument, buy it when it's low and no one wants it. And as soon as something goes wrong in the world, the gold price goes up.
Inevitably, it does too. Peter Switzer, good to chat as always.